Good morning, Ed.
Good morning, James. Thanks for that, Andrew. Thanks very much for the very helpful lead into this. Good morning, everyone. I'm going to talk this morning about the proposed combination between GCP Infrastructure and GCP Asset-Backed Income Funds. Excuse me, I apologise. I've got a bit of a cough, but I also mentioned the ongoing discussions with RM Infrastructure. Obviously, the warnings. I put this slide in just so you can see a tiny picture of who I am. I don't like the large mugshot with my big shiny head, but that's me in the middle of the screen.
I'm afraid that's in the pack later on.
Oh, that's no good. So that's me. My name's Ed Simpson. I've actually been at Gravis since January as head of energy and infrastructure, but I'm also working very closely with Phil Kent, who's the chief exec and the lead portfolio manager on both of GCP Infra and Gabi. This really just highlights that we have a large team that's already focused and dedicated on managing the investments in these funds. We could go to the next slide. Thank you. This is really just to give a bit of context on the GCP Infrastructure Portfolio. GCP Infrastructure has been going 13 years now. It already has a very mature and a diverse portfolio of UK infrastructure assets. The sector and analysis are shown in the pie chart. I think the key things to pull out from this is we've always focused on diversification. So we've got diversification across asset types and across sectors. So we've got PPP assets. We've got about 23% renewables, 67%, and 10% social housing, which is all supported living. The diversification for us has been absolutely key. And I can talk that a bit further into the presentation. It's also worth pointing out that whilst GCP was set up before ESG was really a thing, all of these assets actually make a positive sustainability impact, either social or environmental. And we think that the positioning of these assets will provide really strong support for the returns on an ongoing basis. I can flick to Gabi now. So this is the Gabi portfolio. Again, here, it's worth highlighting that we have diversification across, this time, 59 investments. So I didn't highlight on the chart before, but in infra, we've got 47% in inflation protection. In Gabi, we've got 53.5% inflation or interest rate protection. So again, this really shows that despite the headwinds in the macro market, the increasing inflation, we are to an extent covered against the increase in inflation. It's also worth highlighting that whilst the assets, the sectors are different to GCPs, they're actually very complementary and also positioned to benefit from macro trends of population dynamics, decarbonisation, and energy security. So excuse me. Again, we think these are very complementary portfolios, and similar to GCP, we're focused here on debt. In Gabi, 71% senior and 29% as subordinated loans. The key thing, I think, really for GCP to highlight here is that the weighted average remaining life of the loans is 5 years. That compares to the 10-year weighted average loan life for GCP Infra. So again, there are, I'll talk the benefits of the combination further down. If we could go to the next slide, Andrew's very kindly given some discussion on the macro background and the headwinds that have gone, which we believe too far. Obviously, our focus at Gravis is in managing the investment companies and making sure that the NAV and the returns are as strong as possible. But obviously, we operate within the wider market. So I thought it worthwhile just pulling out a few of these charts. So if we start from the left, this shows the interest rate environment from when the investment companies were launched. So we've got 8 in the case of GCP, 8.44% weighted average returns on or yields on the loans. Those loans were made during periods of very low interest rates. As the credit market has reset in the last year, you see the significant increase in base rates. It's understandable that investors will also look for yield elsewhere, and the relative attractiveness of the yields on GCP and Gabi have become less attractive given the high yields available on government on gilts and other fixed income. However, that also means that the investment opportunities in front of us have also increased. So there are some very attractive investment opportunities in the market right now where both GCP and Gabi can be investing funds at higher rates. Although given this, the increase in yields, I think both boards have been very clear that the focus right now is on de-gearing. And that leads to the second chart, which does show that both GCP and Gabi have traded at a significant discount over the last 12 months, and that's pretty new for both companies. As I said, we've been focused on the strengths of the underlying portfolios and focus on de-gearing, but it's clear that there is a big discount, and we and the independent boards have been talking to investors and looking for trying to find ways to support our shareholders. Then I guess going even more macro into the third chart, this really for me is why we've focused on diversification in the funds. When these funds were launched, infrastructure as an asset class was relatively new. The yields available were very attractive. I remember when I first looked at my first wind turbine investment opportunity. So back in about 2007, 2008, and we were looking at a 12% ungeared IRR. Now, as Andrew was saying when he was looking at some of the investment trusts, investment companies that have focused on purely on renewables, I think any of those funds would bite somebody's arm off to get ungeared yields like that now. So that's partly because the sectors themselves have become established. So the risks are better understood, and so the risk premium is not required so much. But it's also been as a result of more and more capital being raised in the sectors, and so there's more capital looking for investment opportunities, and therefore the price goes up, the yield comes down, and that's why both GCP and Gabi have been focused on the diversification, not being stuck in a single sector, where as capital is raised, the yield available for investors has gone down. It's also worth highlighting that the government has changed its approach to subsidies. Back in the day, the PFI, PPP world, and even to an extent with ROCs and feed-in tariffs on renewables, the government was making very clear and explicit subsidy support and revenue support for new infrastructure assets. The government, and I think everybody recognises, there's a significant need for investment in new sustainable assets that will support the decarbonisation of the UK economy. But the government is no longer doing it through direct subsidy support. It's doing it in other ways to support and create markets. So again, that creates opportunities for both GCP and Gabi to find new and attractive investment opportunities. The final chart on the right is again to highlight that or to recognise that many of the there's been significant consolidation in the wealth management sector. that has meant really that the lots of the investors in our funds and in other investment companies and investment trusts are looking to have investees looking for target companies like ours that have the scale, that give them the liquidity and the scale where they can deploy funds. So again, that's one of the drivers we think for ensuring that we have investment companies that are at scale for the investors that they desire. That then leads very nicely into, well, why have the boards of Gabi and GCP Infra proposed the combination? Obviously, highlight this is very much, these are proposals, they're subject to shareholder approval. It's obviously something that Gravis recommends. We think it is in the best interests of each set of shareholders as a whole. We can see some very attractive reasons for it, and I'll highlight these now. So what exactly are we talking about? It's a combination of GCP and Gabi that will give a sizable debt investor in the infrastructure and real asset sector, with a focus on, as we have naturally developed, to focus on sustainability, where we think there's some real tailwinds to support both new investment opportunities and also support the value and the ability for the underlying borrowers to both grow and service the debt that we provide them. Through the combination, we're proposing to create a liquidity pool or de-gearing for shareholders. So that would be 100 million of de-gearing, so reducing the RCFs that both companies currently have. The expectation is to do that well within 2 years and return another 200 million of capital to shareholders in the 2 years post completion, and that would be through a combination of buybacks, tender offers, or otherwise, in order to get the liquidity for shareholders. As I've highlighted, in order to do this transaction and also to recognise the changes that have occurred to the infrastructure market over the last 13 years, we're looking to reposition the enlarged GCP mandate, and that will bring a focus on sustainability. It will also recognise that there will be no new, or right now we can't see any new material directly government supported revenues, but there are opportunities where there is the government is creating a market and where revenues are highly predictable on real assets. We're also proposing to introduce a continuation vote, which neither company has right now. So this would be again to give shareholders the ability to review the ongoing operations of the business in a formalized way, and finally to recognise that bringing GCP and Gabi together will hopefully have some economies of scale. Well, we know it will have significant economies of scale in the removal of certain overheads that are currently duplicated. So we won't need 2 boards, 2 administrators, etc. Gravis has also agreed to reduce its fees on the assets on the NAV over 1.3 billion. Hopefully, I've kind of highlighted some of the rationale benefits as I've been going through, but again, just to reiterate, we think the increased scale and liquidity is going to be helpful for shareholders. By combining it, we will have a faster capital reallocation. As I highlighted before, GCP has a 10-year weighted average loan life. Gabi has 5-year weighted average loan life. So by combining the two, we'll be able to reset the investments. So we'll be able to provide the 200 million liquidity and de-gearing that I've just highlighted, but there'll also be the opportunity to reset the investments, where maybe 12 months ago we'd be potentially on a competitive basis, being able to lend at 7 or 8% on an investment opportunity. We're already seeing that those opportunities have been reset, and so for exactly the same risk, the same opportunity, would be able to be lending in at significantly higher than 8%. So the combination of GCP and GABI will allow faster reallocation, resetting, and hopefully bringing up the weighted average yields on the investments as the whole. And I've talked about the mandate. I think finally, just to highlight, is we have here. I'm not going to talk about it because it is still in due diligence by the GCP board, but we're also still talking to RMI. So after proposals, what does that mean for the long term? With the scale and the provision of liquidity, we've been talking to shareholders and the board's advisors have been talking to shareholders and understood that liquidity has been important. So the first thing we will do is meeting those liquidity commitments. So that is the commitment to de-gearing and returning at least 100 million more to our shareholders. In the medium term, we will then be able to reset the portfolio, as I've just discussed. Will be bigger scale, so that will hopefully give shareholders greater liquidity in the share pool, and we will continue to have a pool of very attractive UK investment opportunities. So I've highlighted the three sectors that both, or three themes that both companies benefit from. Decarbonisation, so that's the transition to net zero. We've already got exposure to renewables and some transport, but there's industrial decarbonisation, there's natural capital markets, there's heat transport and wider energy transition, all of which will provide very significant investment opportunities in the years to come. Similarly, population change, there's going to be continued need for social infrastructures, housing, healthcare, education. There has been private provision of healthcare leisure before. We have highlighted that neither fund is looking to make further investment in supported living, but there will be opportunities in other areas. And then finally, again, some significant investment opportunities in infrastructure renewal to extend the life of the assets. We could go to the next slide. Thank you. So we believe that the combination will provide or produce a leading real infrastructure and real asset debt investment company. The consolidation, we think, will produce the scale that investors want. It will allow us to provide significant cash back to shareholders, whilst also building a company that will have very attractive investment opportunities for the long term going forward. If I could go to the final slide. I won't read through all of these. I'm hoping I've highlighted everything so far. I think the one which I haven't specifically pulled out is the share register. So there is significant crossover in share registers, so we believe that a combination should benefit that. I haven't mentioned cost optimizations, so the removal of certain fixed costs has been estimated to make an 800,000 benefit for the companies on an ongoing basis. There's also the fee reduction, so recognizing that as the companies return to growth, there will be the costs, investment advisor costs will have a tiered fee. And finally, Gravis has agreed to make a contribution towards the cost of this transaction of £1 million. That is me. So I think it's over to you, James.
Thanks, Ed. That's really helpful.